Ladies and gentlemen, I'm Brandon Wilson with Wilson National LLC here, and today I am with Greg Smith with IPX 1031. He specializes in doing 1031 exchanges for individuals and handling those for them. And so he's here to answer a few questions for us. I know we're in a new year, 2023, and if there's been any changes there, much at all to it, and kind of what he sees going forward, and some very interesting questions as well to kind of give you guys more information exactly what a 1031 exchange is, how it works, and a couple, maybe few more complicated questions to it for those that might be interested. So first off, Greg, thank you very much for having me, meeting me, and giving me the opportunity to speak with you on that and inform our clients and some of yours as well. So to start off, could you give me a little information, how long you've been doing this, what got you in it, just a little bit of background on yourself for people watching?
Thanks, Brandon. So our company's called Investment Property Exchange Services, Inc. So we go by IPX 1031, make that a little shorter. I've been with the company over 20 years now, doing nothing but 1031 exchanges. Prior to that, after graduating from the Ohio State University, the College of Law there, I was in private practice for a few years. And then after that, I switched over. I was a closing and underwriting attorney with Chicago Title. And that lasted about 3 years. And then IPX had come into the Midwest. I jumped aboard that train, and nothing but 1031s for over 20 years now.
Wow. So you got a little bit of experience though with them then.
Years are starting to add up. Yeah.
I understand. I guess the first question I have is, can you explain the basics of just like what is a 1031 exchange?
Sure. So the name comes from section 1031 of the tax code, the Internal Revenue Code. And the basic idea behind it is really as simple as the government's being nice enough to give you a tax break that when you sell your real estate that's either used in business or held for investment, and instead of pocketing that money, you go ahead and reinvest it into more real estate, used in business or held for investment. The government says, great, because you didn't pocket the money, you just moved it from asset A to asset B, we're not going to tax you on that sale.
And that tax would be, the capital gains tax.
That's right. Correct. Capital gain taxes can apply, the depreciation recapture tax, if it's something other than land that has buildings on it, or any kind of farm buildings and things that a lot of your clients are using, things that are depreciated, they would normally tax that at 25%. The long-term capital gains are 15 to 23.8%. State of Ohio, as an example, will get you for about 5%.
Gotcha. Okay. So there's pretty big tax consequences there. So that's why a lot of people are obviously using it today.
Absolutely.
I guess when should a seller begin planning for executing a 1031 exchange?
Yeah, I think the quick answer is the sooner the better, because you never know what issues might be there, and we like to review the contract early on, review the title commitment when we can get it, and be able to walk the client through the process. Most exchanges are pretty straightforward. We do get calls from the closing table where people didn't set it up in advance and they're there ready to sell the property right then, and we'll still get that done for them. We can react last minute when needed.
Okay.
But it's not ideal, and there could be situations like if you've got an LLC with multiple members, some members want to exchange, others don't.
Yes. Or
maybe there's going to be related parties involved on the back of the exchange. Those are things that need to be worked out ahead of time to see if the deal can work.
Gotcha. Okay. The next one is, a lot of people, they have to identify a property, and we'll kind of get into that a little bit more. But like, how many properties can they identify for a 1031 exchange? You kind of go into the identification of what's maybe the purpose behind that and how that works.
Right. So from the closing date of your sale, you do have to identify what you're going to buy within 45 days after that closing. And the identification rules are a little bit strange. The first seems simple enough. It's called the 3 property rule. It means you can always identify any 3 properties that you might want to buy without any restrictions. Okay. There are some quirks to that we won't bore the audience with today. Then there's the 200% rule. So let's say you want to either possibly buy 4 or more properties, or you at least want to identify 4 or more properties as possible targets that you might buy. Now they say you have to stay within a 200% limit, meaning if you sold property for $500,000, the total aggregate value of all the properties that you list cannot exceed a value of $1 million, 200% of what you sold.
Yes.
When you're naming 3 or fewer, that does not apply. So it's okay to name properties that are much, much more expensive than what you sold, but you can't do that if you're going to name 4 or more properties.
Gotcha. So basically, in essence, you could probably name as many properties as you want, but those values of those properties couldn't come up to more than double whatever the property is you're selling. Is that right?
Yeah, you're going to get cut off because unless you're naming really, really cheap properties.
Yes.
Because again, if you sold for $500,000, your total limit's $1 million, so you could name 10 properties for $100,000 each, but you can't name an 11th property.
Yes. Okay. Wonderful. The typical when do you need to identify? I think you kind of already went over that a little bit. How do they on the paperwork identify, the properties for the potential replacement? Is it a parcel number? Is it an address? Is it a legal description? How do you go about identifying those?
The IRS wants the identification to be unambiguous, so they can look at it and know exactly what you were trying to buy, and there's nothing up in the air about it. So certainly addresses usually work.
Okay.
Parcel numbers usually work.
Gotcha.
And anything that's going to tell them what the property is, and nobody would look at it and say, oh wait, that could be this property or that could be the one over here.
Yeah, it makes sense. Just like writing a contract. So
When
you have these, how long does it take to close on a 1031 exchange? Can you do it as quick as you want, or what's your limit as how long you're also allowed to take?
So if you're using the same title company or closer for both the sale and the purchase, we often have people close them back to back. You could close 2 p.m. on the property you're selling, 3 p.m. on the property you're buying. That's okay to do.
Okay.
If it's going to be 2 different title companies involved, the IRS will require that the money comes into the exchange account first, and then we handle it before it gets sent back out to the second title company.
Gotcha.
So we usually recommend having at least 2 business days between the closings, just so your client doesn't have a heart attack that things aren't getting done in time. Because wires are never quick as people think, and it might take the first company till the next day to get it out, those types of things. So give yourself a little bit of time, but the bottom line there is it can happen very quickly. Then they have up to a limit of 180 days. So from the time you sold your old property to the time you need to be fully closed on the new property, you have to get that done within 180 days.
Okay. And I guess while we're at it, what happens to your money there if you don't get properties identified?
Mm-hmm.
Okay, something happens, you don't have any properties identified, and then 2, if those properties aren't, or you do get properties identified, okay, but you don't get closed on any of them, what happens to those funds in each case?
Yeah. So the IRS has very stringent rules on how a qualified intermediary, a company like ours, holds the funds. And we become the principal in the transaction, which is kind of strange. So when they go to sell the property, we get assigned into that contract as a technical seller.
Mm-hmm.
Now in most exchanges, we do not have to go into the chain of title, which is great, but we do become the technical seller through the contract. And what that means is the title company can wire us the funds. We have to hold that in our account that we technically own by law. And then the exchanger can use those funds anytime he or she wants to, but they can't get them back instantly when they don't use them towards buying replacement property. So if they don't ID property like you mentioned, then the exchange is going to end after 45 days. So on day 46, we're going to wire their funds back to them.
Gotcha.
Or even if they did buy property but they didn't use all the money, we're going to wire the excess back to them. If you're past day 45 and you do have identified property to buy, then by law the IRS says you have to have the rest of the 180-day period to possibly buy those properties. So that's where the client would have to wait until day 181 to get the money back. So
gotcha.
It's kind of strange, but the bottom line is they can use it to buy property anytime they want. Other than that, they have to wait till the exchange is officially over, then they'll get their money back.
Gotcha. And so also with that, obviously maybe a point I kind of missed there is when a person does a 1031 exchange, okay, they don't actually end up, if they sell a property, they don't actually end up getting the funds from that closing. They actually go to you, the intermediary, which is a portion of the job. And so when he's speaking about that, to clarify, they're actually holding the funds, okay, and then they are the buyer of the replacement property.
Yep, that's right.
Okay, and so that's why they'd be holding the funds. Now, if somebody, let's say somebody has they identified properties within the 45-day mark, and on day, 96 or whatever, they close on, they only identified one property, they close on that, but it doesn't take their whole funds.
Yeah.
Do they get the rest of the funds the next day, or then do they still have to wait the rest of the 180 days to
Right.
get the rest of it?
They would immediately get that money back because the exchange is over at that point where all identified property has been acquired.
Gotcha.
So there's nothing left to be possibly purchased. It's over.
Okay. Well, good. The replacement property, as far as being the same, higher or lower value,
Yeah.
does that matter at all?
Yeah,
Or
so it's not required to have 100% tax deferral when you do an exchange. It's okay to do a partially deferred exchange where the client's gonna pay some taxes and defer some taxes, but most clients don't wanna pay any taxes.
Yeah.
So in your most standard exchange, you need to do two things. Number one is if you had debt on the property that you sold, so if you paid off $250,000 to the bank when you sold your property, and you walked away with $500,000 in cash that gets sent into your exchange account, they want to see you use that cash as down payment on your new property, and they want you to replace the amount of debt you paid off. So if you paid off $250,000 of debt, go get a loan of $250,000 or more on your new property, or you could add $250,000 in cash if you wanted to from outside of the exchange. So the quicker answer to your question is, yes, they want you to buy a property of equal or greater value to get 100% tax deferral. But
Yes.
specifically, it also means don't keep any of the cash. And as a benefit, closing costs do come off the top. So any real estate commissions, exchange fees, title fees, those normal closing costs, you're not expected to make up for those. So if we said someone sold property again for $500,000, maybe they have $50,000 of real estate commissions, title fees, exchange fees, and so on. So they're really walking away with $450,000. They need to reinvest the $450,000 to get 100% tax deferral.
Gotcha. Okay. Let me think here. Here's a good one. Can debt on property being sold be transferred to the replacement property?
Yeah, it could be. So that could work a lot of ways. If you've got a lender who won't even require you to make a payoff, and instead they just take a lien on your new property, that can be done.
Okay.
But most often you pay off that debt on the old property like you would in any closing, whether it's an exchange or not. And then when you go to buy your new property, like we were just talking about, you would get a new loan of equal or greater value to the old loan to stay 100% tax deferred.
Okay. All right. That works. Are there restrictions on types of property to be exchanged? And I know I've talked to a lot of people about this because as far as, farmland for storage or warehouses,
Yeah.
or even, I say a vacation home, and I say that with quotations a little bit because
Yeah.
there's a little bit of a trick to that, as I understand. And so what kind of properties, the terminology is like kind of exchange.
Right.
But if somebody wanted to sell their farm and go get a vacation home,
Sure.
is that possible with a
Yeah.
1031 exchange?
Yeah, so the rules are very flexible there, which is nice. Like kind means any type of business or investment real estate can be traded for any kind of business or investment real estate. So it's okay to sell your farm and buy an office building, or sell your rental property and buy a farm, those types of things. But when you want it to be a vacation property, the IRS came up with this safe harbor. And the safe harbor means if you follow those rules, your exchange can never be challenged. If you're outside of the rules and you're unlucky enough to get audited, then they're going to decide if you meet the investment criteria.
Okay.
So what that safe harbor says is, let's say you've sold a farm in Ohio, you buy a beautiful home on Hilton Head Island. Well, you do want it to be some kind of rental at the beginning. They say you have to rent it out at least 14 days a year for the first 2 years.
Okay.
And they give you some personal use. They limit it, but they say you can use it personally 14 days a year for those first 2 years, or 10% of the total number of days rented. So if that Hilton Head property, you rent it out pretty much all the time, and you've rented it 300 days in a year, means you'd be okay to use it 30 days personally in that year, and you still meet the safe harbor and you're qualified in that year. And if you meet those criteria for 2 years, once you get to year 3, you can do anything you want with the property from then on, and your 1031 will never be challenged.
Nice. So you can pretty well easily, as long as you handle that vacation property as an investment for 2 years, don't stay there too much, okay, and make sure other people stay there even more,
That's
for
right.
2 years,
That's right.
then you can do that, and then on the third year you can have a ball.
Yeah, and the
Right.
safest thing for them to do would not be to stay in it at all, but let you stay there for 1 week and I'll stay there for 1 week.
Yeah,
and
that'd
they
be
know
o-
they'll be okay.
That'd be okay. We'll have to include that in our fees.
Yeah.
Let me think here. I know a few years back, you used to be able to do, and please correct me if I'm wrong, you used to be able to do exchanges on personal property. Okay.
Right.
But from my understanding, you can no longer do that. Is that correct?
That's exactly correct. So what happened was, with the Tax Cuts and Jobs Act that I think became effective in 2018, 1031s became real estate only at that point.
Okay.
Prior to the Tax Cuts and Jobs Act, our company was doing exchanges on all kinds of things: business equipment, aircraft, pretty typical, fun things like artwork and racehorses and collectible cars. Almost anything that had a capital gain tax could be in a 1031 exchange. And that's where like kind was so important. If you sold a certain kind of equipment, you probably had to buy the same kind of equipment.
Yeah.
But within real estate, it's real estate for real estate, which is nice.
Yeah.
But yeah, other than stocks, bonds, and notes, you used to be able to do a 1031 on just about everything. But these days, 100% real estate only.
Huh. Yeah, that would have been. I know a lot of our clients used to use that quite a bit, especially if they're selling equipment.
Sure.
That was very beneficial. But
Yeah, I mean, we did lots. I mean, hundreds of farm transactions where, the real estate would be part of an exchange, the livestock would be part of an exchange, the combines and tractors would be exchanged, but now it's just purely real estate. On those other things, you get something called immediate expensing now. So if you go out and you buy a new combine, you can immediately expense it. There's different tax breaks that apply. They're just not part of my 1031 exchange world.
Yeah. Did you see? I guess did that slow you guys down somewhat when that happened, or I mean, it seems like you guys still it's very very busy.
It didn't slow us down at all. In fact, ever since the Great Recession ended, more than a decade ago now, it's been nothing but this, both for our company and our industry. Someday when real estate is on a downward part of its real estate cycle, that'll hurt us a little bit because we won't have all those other types of exchanges to do. But real estate's been so hot in recent years.
Oh yeah.
Yeah.
Well, since that
going crazy.
Since that recession, we had a spike there right after that, right around 2012, and then got up and kept going about to 2015, and then seemed to kind of level off, and then COVID hit, and 2020 kind of came around to that, and then it took another
Absolutely.
went up again. So wonderful, especially for you and I. So we won't complain about that one bit.
No, not at all.
Here's an interesting one. Dad wanted me to mention to you. There's a lot of people. You have utility easements. Okay, there's a lot of solar going on as far as solar leases, and so I guess the first question is, for utility easements, if you receive funds for if they're putting in a big utility line, and they're going to give you $40,000 an acre, and it's a mile long and 60 foot wide. Okay, can you use those utility easement funds? And also, could you use solar lease funds that you probably get on a yearly basis? Can you use those and do 1031 with those?
Yeah, so usually the answer is yes. So the first question you look at with an easement, most easements are perpetual easements, right? They go on indefinitely. Perpetual easements are considered like kind to fee property or normal ownership of property, absolute ownership. So if you sell a perpetual easement on your property, you can use that money. You could go out and buy more farmland, you could buy an office building, etc. So that's pretty standard. That's always been the case. I haven't dealt with any solar easements specifically.
Okay.
Anytime you're looking at an easement or a lease, if it's 30 years or more, it's generally going to be considered like kind and like kind to fee. You always have to look in any particular state whether the state is calling that item real estate under the law or something else.
Okay.
So most states call things like oil and gas, air rights, mineral rights, they call those things real estate for 1031 purposes.
Okay.
I think solar is going to fit into that same category, but I haven't I haven't dealt with that issue
Gotcha.
personally yet.
Well, I know,
think
it's just kind of, it's starting to become a big thing, especially in Ohio. And then I guess the next question is, for some of these, solar leases, there are options out there for individuals. And I might try and find a time to speak with someone and do a video on that, to where they can, if they have their 30 or 40 year lease, okay, to where they could sell that lease out to somebody else for a lump sum.
Right.
Would that also fall under the same umbrella there, or
I think that's
would that
going
be
to. I
different?
think that's going to qualify. Just a question of if under state law they called those solar rights real estate rights, they probably would.
Gotcha. Do you think the years, as far as, well, maybe somebody had a 25-year lease, but then they're getting this large chunk of change.
Yeah,
Depending
so-
upon that, would that possibly have an effect as far as how long their lease was, even though they're selling it all?
25-year
Did they-
lease alone wouldn't be considered like kind of fee property. You could sell a 25-year lease and go buy a 25-year lease. That's like kind.
Yeah.
But to get it to be considered like kind of full ownership, it'd be a little different. But it's always with options included. So people can go back and just rewrite those deals, quite honestly. And they can say, okay, 25-year term with a 10-year option period to be decided on terms at a later date. Now that's technically a 35-year, which would qualify.
Gotcha.
So there's always a way to get there.
All right. Well, that's neat. Interesting to know. Here's another one I had. If you got land that's in a trust, okay, a lot of people have them, in trust. All right, and there's multiple beneficiaries. I want to make sure I say this right.
Mm-hmm.
Does the replacement property need to be in the exact same ownership, or if somebody wants to, one of the beneficiaries out of the trust, half of them want to just, no, I want to pocket the money, I'll pay the capital gains. But then there's a couple that are like, no, I want a 1031 exchange. Does the ownership have to stay the same, or is that able to be split up at all?
Yeah, so this will be about a 3-hour answer. So bear with me. So I'll try to give you the short answer though. No. So this is very similar to questions that come up with LLCs and partnerships. When some members want to exchange, partners want to exchange, or beneficiaries in a trust want to exchange, others don't. The general rule to start with is whatever the entity is that sells the property, that has to be the same, person or entity that buys the replacement property. It's got to be the same taxpayer on both sides of the deal. So in a case like that, you'd have to take steps. They'd always want to work with their tax advisor here, make sure they're doing it right and everyone's comfortable. But we have seen deals where trusts will go ahead, and if it's just one person out of many that wants to exchange, the trust might deed out Joe and Joe's 10% out to Joe. Then Joe will actually deed his 10% over the buyer when the trust deeds the other 90% to the buyer, so that Joe can exchange with his 10%.
Gotcha.
So that's the kind of idea behind it. There's almost always, again, a way to get there. That's, again, somewhere where you want some advanced planning. Don't call from the closing table and say you want to do that.
That one might be a little tough to do.
We're not going to get that done in a couple of hours.
Yeah.
So you want advanced planning, but there's almost always a way to accomplish that goal.
Gotcha. So there are definitely options out there that could take 3 hours to explain them all. And so if you have questions about those, call Greg Smith.
Absolutely.
What if a planned exchange? Already went over that one. Here's one. How should an owner of the replacement property deal with the contract to sell? Is there certain language needed in the buyer's purchase contract? So, I know there's a lot of people out there that sell their own property, and a lot of times you'll probably go to an attorney to get something written up.
Sure.
But there probably is some language that needs to be in there. I know we have it, basically saying that they will work with the buyer or the seller during their 1031 exchange. Is there certain languages out there that you probably recommend for our company and any other real estate companies or attorneys out there to make sure they keep in there?
We do recommend that kind of language in both the contract for the property you're selling and the contract for the property you're buying. The IRS technically does not require anything to be in the contract, but what you end up doing, like I mentioned, is you're assigning your interest to the QI in that contract on both the property you're selling, the one you're buying. So it is a good idea to have language in there for that reason alone. What the IRS does require is simply that you make the other party aware of the 1031 exchange.
Gotcha.
The simplest, cleanest, best way to do that is in your contract.
Yeah, have it written out.
You know,
so
technically, if I just said it to you in the closing, hey, by the way, I'm doing a 1031 exchange, and you don't sign or do anything, that's still okay. That covers the law.
Yeah.
But you don't have anything to show that actually happened other than your recollection later.
You could always, somebody could always refute the word of mouth, but if it's in the contract, then it's in the contract.
Yeah.
And so always better to have it written out. So that's wonderful. One thing I know a lot of people run into is, I wish I would have done a 1031 exchange. And so with that being said, I know there's, what's called a reverse Starker 1031 exchange. And so can you explain exactly how that works?
Sure.
For our listeners.
Yeah, so a reverse 1031 exchange is when the client wants to buy their new property before the time they've sold their old property.
Mm-hmm.
So the IRS gives you a way to do it. Unfortunately, they don't make it easy.
Yeah.
Okay, it's a much more complicated and unfortunately expensive type of exchange if you need to buy first. The main reason for that is the IRS won't let you own both the old and the new at the same time. So if you're buying the new first, how do you get around that? Well, they came up with the idea of an accommodation title holder, which for all intents and purposes is an LLC our company sets up. We take title to your client's new property in that LLC, and they're still paying for it, by the way, or their lender's bringing the money.
Yeah.
But we're in bare legal title. They'll have control over the property from day one. From that closing date then, the IRS gives them 180 days to get their old property sold and complete their exchange then when we transfer the new property over to them.
Gotcha. So the biggest difference is obviously with that, you're buying the property before you're actually selling yours. Okay. With that, it costs more because you guys actually have to take title to the property. Now they still remain completely in control of it.
That's right.
Okay, as the buyer, but since you have to take title, there's obviously some additional fees there in creating the LLC for that. Would that be correct?
That's right. There's additional fees for the extra paperwork. There's a lot of work with dealing with lenders when there is a lender involved, walking them through the process on many deals. And then a lot of it's quite honestly because of our risk. You don't really want to be in contract on other people's property.
Yeah.
Through the years, we do so many of these nationwide. We get dragged into lawsuits. Some from the EPA, if they found an EPA, an environmental problem at some point, they say, well, you were entitled when it was there, so you're on the hook too. That happens. We could be entitled to a restaurant in Phoenix and somebody gets run over in the parking lot, killed. We're going to get sued because we're entitled to property.
Yeah.
So those kind of things just happen. We do all we can, of course, to limit our liability, but just more happens, you got to deal with it.
Mm-hmm.
So, yeah.
And obviously you guys work through all those just fine.
Absolutely.
Yeah.
Yep.
With a little bit of work. And
again, most deals aren't problematic, but we have to have that built into the deal.
You always have to have a what if scenario. We always have to go over that with our clients as well. I guess one of the final questions I have is, if you don't mind,
please.
For a typical 1031 exchange, can you kind of give somebody, and I know maybe there could be some changes there, but can you give somebody, for your company, what's the typical cost? If somebody wants to do a regular 1031 exchange, or if they want to do, a reverse Starker and they've already purchased the property.
Yeah. So the vast majority of exchanges, the standard exchanges, which they call either delayed exchanges or Starker exchanges, we charge flat fees for those no matter the value of the property. We charge $1,000 to set up the exchange and handle that initial sale. We charge $250 per additional closing. So where they sell one and buy one, total fee of $1,250, that's going to cover everything.
Gotcha.
That's 90% of deals. On the reverse exchanges, or sometimes people do construction exchanges where they also want to build as part of the deal, those are much more expensive. They generally start at around $6,000 in fees, and they'll go up based on the value of the property, whether a lender's involved, whether construction's involved, things like that.
Gotcha.
So they could be a few $1,000s more than that, depending on those other factors.
Gotcha. So basically, if you can set it up to sell yours first and then buy later, that's probably the best bet.
Definitely easier from a 1031 standpoint, but there are a lot of good reasons. A lot of times companies, they want to buy first, they want to get that property up and running before they sell the old one. Reasons like that. Yeah.
Especially with how tight the market is and just being able to find property right now.
That's
I know a lot of people run into issues is like, I got mine sold, but I I can't find a property, you know, Brandon, you got to help me out here. And so, you know, but that's what we're there for as well. So
Absolutely.
I think that's, you know, are there any questions I've missed that I probably should have asked? Anything like that, Greg? Or?
I think you did a great job. I think that's going to help everybody out. Like you mentioned, they absolutely can just call me or email me anytime with questions. We never charge anything for consultations, so we're always happy to sit down with you and your clients, have a phone conference and say, here's what works, here's what doesn't work. Never any charge for that. So they should feel free to ask questions anytime.
Awesome, wonderful. Well, I'll make sure, folks, that we have Greg Smith's info there in the video for you, his email and his phone number if you have any questions for him, and also ours will be there as well. Greg, thank you very much for your time today. Really appreciated the talk. I learned a few things, and hopefully everybody listening and seeing this video learned a lot as well. If you have any questions, you're always welcome to call us. I'm Brandon Wilson with Wilson National, and this is Greg Smith with IPX 1031. Thank you for your time, Greg. Appreciate you, sir.
Thank you, Brandon.
Hey, have a good
Appreciate
one.
it.